All right, we're live. Can you see me?
Yeah.
All right, all right. So, good evening, viewers. Welcome to 360 Finance. And this week we have a very, very special guest, and his name is Emmanuel Suraj. And it will take me at least 5 minutes to just discuss his introduction. So, I will go very, very slowly, just try and annihilate what I'm trying to say about him. He's an investment strategist with a background in analyzing the financial and operational performance of companies across diverse sectors, experience in analyzing equity, credit, and hybrid instruments. With over 12 years of value, growth, and speculative investing experience, of which 8 years as a professional in Indian and global capital markets, maintaining a record of reliable analysis across global economies amongst diverse sectors, created a benchmark in projects by executing new plots, including hypothesis testing, portfolio structures, option strategies, trade practices, analysis feed, and in investable vision boards. A scholar with gold medal from Amity University, Noida. I guess most of the students out from Amity School, Noida know him. I told a couple of my interns and they were like, sir, Emmanuel sir aa rahe hain. बहुत सुना है उनके बारे में. So you're gonna live very soon. Went on to pursue research internship with Cleveland University, South Carolina. Trained in business analytics by IIM Kashipur. Trained in advanced derivative options strategies by IIM Ahmedabad. Certified equity researcher and company evaluator by Moody's Analytics. So, 5 minutes on and still live. Worked at Bajaj Alliance Life on their jewelry products. Worked with Nikun's Stockbrokers Limited as their VP, Strategy and Research, and currently working with A3D Capital as a business head, and parallelly serving as Chief Investment Instructor at Together Investing Club. Welcome, everyone. Welcome to our channel 360 Degree Finance.
Thank you, KV. Thank you, Kulbhushan. Thank you so much. And though I wanted it to be short, thank you for covering everything.
It cannot be short, Emmanuel. You are not a very common man, right? हम लोग के लिए ना हवाला होता है कि हाँ एक्स बैंकर आईसीसी बैंक से हैं, so वो छोटा मोटा हो जाता है, but for Emmanuel it has to be long, right? People need to know who is Emmanuel Suraj.
Yeah, and that is how I chose life to be. I didn't want to join any of the big brands because of how myopic one becomes in terms of operations or in terms of how they execute their day-to-day activities. I wanted to be slightly off the grid there. So yeah, thank you so much for the introduction. And
fine, man, fine. Well, I mean, I can probably see upcoming. If you don't say a fund manager, probably a content creator like Rachna Ranade, or other names. I can probably see your name there, right? So, Emmanuel, you do a lot of things. So, how do you plan your day? I specifically face this problem and almost ask each one of my guest speakers, how do you plan your day? In our field, we need to be from 9:30 to 3:30. It is only about market. Rest of the time, we are learning, and we need to learn so much. We need to then deep dive into stocks. Lots and lots of things to do. So, how do you manage all those things?
Well, so I was not prepared for that answer because I was not wondering you to ask. But then now that you have, on a very lighter note, it does get quite overwhelming. And because of the two hats that I wear during my day, one is as a market researcher or an analyst, and the other is as a business guy or a sales guy who is selling investment products or investments, or probably selling businesses to people with surplus money to be able to invest in these instruments as well as businesses. So how I plan it is very simple. I'm in office by 7:15 every day. So
all right. 7:15 in the morning?
Yeah. So thanks to the network that we are commonly a part of, I'm a morning person now. So 7:15 I reach work most of the times. It should be some ironical day when I'm not at work by that time. And I love that zone of those 2 hours from 7:15 to 9:15 when the markets are off. There is nobody else in the office apart from you. And you can actually do a lot of deep work. So that's my me time. I use those 2 hours. They're equivalent to 12 hours of my productivity. So once I've done that, I've put those 2 hours at work. Mostly it's about reading, it's about research, it's about looking at the Japanese indexes, looking at the East Asian indexes, and then probably looking at how the US ended. I'm not a great fan of SGX. I know a lot of viewers would found it very contradictory, but not a great fan of SGX and all those early indicators. But yes, that's my time. And then after the markets start, to be very frank, I look at markets only twice in the entire day, or if it's a very volatile day, then three times. One at 9:15 to 9:30, one at 1 if need be. If the market has not moved enough, if my stocks are not moved enough, then probably at around 3:15, 3. These are the only three times I spend at the market. I don't want any undue information overload on me or my strategy. So I just stay there. And probably when the day is off, I take a gap of 1.5 hours and then go out in the field to meet clients. That's how I plan my day. That's how typically a day is. And then on weekends, we are of course, with Together Investing Club. We're trying to give back to the society, try to educate people, try to make them aware about things, and that's how the week goes ideally. So not much fun, but yes, it does take a toll sometimes. So a lot of detox is required, but then that's how it is.
So you're actually getting 3 hours every single day from very common people, right? Starting at 7:15 is already gaining 3 hours. You are 3 hours ahead for each of us, right? One probably thought that probably both of us share is probably educating people and giving it back to society. Probably in my experience of last 15, 16 years, but I've actually come across people entering stock market, getting some tips, burning their hands, and pledging that they will never ever come back to the markets. That is not actually how it should be. So my motive is actually to train people that they should do a little research before investing. Even if you're getting a tip, try and at least do simple basic checks of that particular stock, so that when you invest, the chances of losing your money should be minimal, right? Nobody can guarantee it, but then you should be prepared for a long term, and then chances of losing money should be very very less. So hats off to you, Emmanuel, actually taking that Together Investment Club to a long way. Can you share about in next 2 minutes about what is Together Investing Club?
Sure. So KB, very very rightly mentioned by you. And the people who quit markets today are the people who come back to markets after 10 years, and then they quit again after 1.5 years. So I started unprofessionally. I started it in 2009. I was 16 when I started, and the markets were recovering. And I know a lot of people who threw towels then, and they've never come back to markets until 2021, right? So the people who quit markets are the people who come back after 10 years, 11 years, 12 years, whenever the cycle comes back. So the problem is not that people follow tips. The problem is not that people enter late. The problem is people don't know what to look at. People don't know where to look at. And most of the times, the financial ratios or the quantitative side of it is very easy. I mean, trust me, if and we just take somebody who is just graduated out of 10th grade and try to put in quantitative things in them, they're able to grasp them. At TIC, we have people who have just graduated 12th or first year of their college, and they do amazing quant. They do amazing analysis through quantitatives. But it's the qualitative that they're not able to achieve. That comes through experience. That comes through how much depth have you, how far have you, spent your time, and how much analysis have you done. And when people ask me of how do you do it, and I tell them I read annual books, front to back for 10 years of any business that I want to invest more than 3% of my capital into. And that's too much work, ideally, when I tell someone. So it's not a part-time job. It's not a part-time business. It's not something that you can do passively if you're very serious about it. And I think that is where people burn their hands, if I can use that word. But what ideally happens at TIC is we try to reduce that span. Out of 9 years of experience of mine, probably out of 2-digit experience of yours, we have built a system, we have built a model in which we run every day, in which we scan stocks every day. So I think sharing that system with everyone, sharing that model with everyone is what helps them reduce the gestation time, and kind of use those 9 years of my hard work into 90 minutes that they can invest on a weekly basis. And then, so I think it's not the problem of who people look up to. It is the problem of people not knowing where they should be looking for authentic data, where they should be looking at, what they should be looking at, and how they should be connecting the dots. I think that is where the problem is. And if we bridge these gaps, I think there is not much difference between a professional investor and a non-professional investor. The only difference is of they know it and the other party doesn't know it. As simple as that.
All right, all right, all right. So one of our viewers is asking him, can you ask him that I am starting at the age of 18? So is it late or am I right on time?
So I generally come across, so I do something called psychometric tests and personal portfolio structures or personal structures of wealth maximization. And people come at 45 and then they ask, okay, now how do we do it? And they want 700 crores of net worth or 7,000 crores of net worth. And it's not possible ideally, unless you're ready to put a lot of investment. Even if you put a lot of investment, see, there are three variables to investing. The first is time, the second is the rate at which you can compound your capital, and the third is how much investment you're ready to put, right? The rate at which you can compound your capital is completely directly proportional to your skill set or the portfolio manager skill set that you're depending on, right? The third is how much capital can you put. Now, that doesn't have any significance, right? How much capital you can put. It's like a billionaires trying to match their yachts, right? I was in Europe for a very short time, and I saw these huge yachts, and you cannot say which one is better than which one, right? Every yacht is in its own sense is big, huge, humongous. At least for people like me who have never traveled in a yacht or never been on a yacht. So it doesn't matter how much money you're ready to invest. So skill set taken out, either you can do it or you can ask a portfolio manager to do it. How much money you're investing taken out. So the only thing is left is time. That is the variable, that is the most important variable that we don't understand. So if someone is 18 and if they're looking at this video, they're right in time. All they have to do it, put in a lot of sweat, put in a lot of hard work, and do not try to get rich in the stock markets. Stock markets are not wealth generating instruments. Stock markets are, or the capital markets are, wealth maximization instruments. They are here to take you to the next level of standard of living. They are here to take you from a Volkswagen to a Lamborghini. They're not here to make you earn a Volkswagen. That's not what is going to happen in the capital markets. And I think the expectation that you should have, even when you're young, is not to double your money overnight. Okay, you double your money overnight. Now what? What will you do? Right? So it should be about consistent compounding. It should be about adding that alpha of 2-3% over the index every year for, let's say, 40 years, 35 years, 30 years. And then you become someone or you become something, and then you can be like, okay, I have enough money now. Now what should I be doing? Right? So things like that. So I think if someone is 18, right in time, start it. I think you have a healthy 40 more years to invest. Ideally, Harvard Business Research suggests that you work for around 40 years, depending on what kind of a profession. My fiance is an architect, so she started working at 25. So probably she'll end up working till 65. I started working when I was 19, so probably I'll end up working till 60 or 59. So it depends. But if you're working for 40 years and if you're investing, my personal golden rule is 30%. If you're investing that X amount every paycheck in the capital markets, I think it's amazingly well. So no one is ever late. It's about when do you hit that momentum and when do you realize that investing is really necessary.
And I know this viewer who is asking. He is one of our well-known intern in my group, and he's studying since like 1 a.m., 2 a.m. in the night, drawing all those technical charts and publishing. कि सर ये आज फिर मुझे IPO अलॉट नहीं हुआ है, लेकिन निफ्टी का चार्ट सही से पढ़ लिया था. So he's one of those good guys spending time in market, and I know he's doing some good work also. So coming back to life apart from finance. So a lot of our viewers are would not be actually aware that Emmanuel, apart from finance, is also a footballer. So I tell you my story. When I met him, I know him almost like 2.5, 3 years. I met him on football ground, and I was like, yeah, finance guy, football fine खेलता हूँ. And I play cricket and different sports regularly. So he was in front of me, and he was about to kick the ball. मैं कहा मार देगा, pass कर रहा हूँ, and then the ball just zoomed past me. I was like, Emmanuel, oh man, you are a great footballer too. So there is a different side to Emmanuel as well. So you can probably footballers can connect with that kind of passion also. So Emmanuel, I go back almost like 6-7 months back when I was asking you. You went on a session live with, I guess, Saurabh Mukherjee. So I asked you that how do you know him, and something about your mentors, and told me that you have n number of mentors and Saurabh Mukherjee is one of them. and probably just a name of Saurabh Mukherjee. People like us who are like this. Saurabh Mukherjee, mentored by Saurabh Mukherjee, should be great. So tell us something about your mentors and how do you got in touch with Saurabh Mukherjee and people like that.
Uh, sure. So there is this book called The Proximity Principle. It's a very fine book, and it's all about how I knew KB and how KB invited me for this interview, or how KB invited me to his show. It's because KB knows what I do. So Proximity Principle, the book is all about everyone should know what you do and what you're passionate about, and then roads just build on themselves. So I have a lot of mentors in the industry. I started very young, and earlier I was clients with most of the mentors that currently are. So my first portfolio experience was ICICI Securities. And when I first went in, it was of course my dad's money and a couple of his friends' money. When I first went in, the first product I bought was a ULIP for all of them. And it was a disaster because in those times, ICICI used to charge 10% allocation charges on the ULIP product. And I was fantasized by how probably I can move between equity and debt without any expense. And probably that was eureka for me, because any other instrument, if I wanted to move between equity and debt, I would have to pay allocation charges, I'll have to pay exit load, taxes, and all those things. ULIP was one platform that was providing me all of that without any expenses. But then there was a 10% allocation charge. So I had to work harder, I had to work smarter than anyone else that I knew at that time, because I had to first earn that 10%. Otherwise, there was no alpha generated in the first year. So how I get mentors is very simple. I try to become their clients, and I try to ask as many questions as I can. And once they realize that I'm not a normal client, and I'm one of probably a future competitor or probably someone from the industry, then they go on the back foot most of the times. And then I have to tell them I mean no harm. I am not going to. I just want to learn. And most of the times, whatever I learn is not what I implement. Most of the times, it's theoretical, because if I learn something from KB today, and if I start implementing it tomorrow without any type 1, type 2 error testing or without any back testing, I'm surely going to lose money. And then I will come back and I'll have bad words for KB. Right? That is what people do. They will learn something from me and they'll start doing it tomorrow onwards. And then they will have bad words for me because I've been doing it for 9 years, and you want to do it after 9 minutes. It's not going to happen the same. So the best way to make mentors is be their clients. That's what is my hack. And if you cannot, for example, if someone does not have 50 lakhs, they cannot afford Saurabh Mukherjee as of date. He's a 5,000 crore guy, and he runs three portfolios as of now. Or probably someone does not has 1 crore, they cannot be clients of Abacus, which is another fine house.
Sunil Singhania, right?
Yeah, Sunil Singhania. And I know Sir Sunil Singhania since he was a mascot for CFA India. He was with Reliance Mutual Funds. He was a mascot for CFA India. I met him in one of the Bombay sessions. So even when I was in college, people would plan going to Thailand. People would plan going to Langkawi on their trips, Goa and all those. I would plan going to Bombay and attending these financial summits and things like that. That was vacation for me. Listening to all these legends and trying to understand. I mean, I was coined the term AIF when I was in second year of college. And I was like, okay, there is something like this that exists. We're just fighting over mutual funds right now in Delhi. There are so many mutual fund distributors. Everybody is fighting for their market share. Nobody had heard a term AIF in Delhi in that point of time. So I think it's about what kind of exposure you can get, what kind of people can you meet, and can you ask those questions that, for example, if someone on this session asks a question that actually puts me in my subconscious mind, I have to bring out an answer for them. I'll remember their name forever, right? And if probably sometime they write me a mail or they drop me a WhatsApp with their name, I will remember and I will want to talk to them. I'll want to interact with them because they're adding value to me, right? So mentorship is a two-way bridge. You will have to add value to them. It's not just them adding value to you. So I've worked as a ghostwriter for a lot of people in the industry. I've worked as a sidekick researcher for most of the people, and that's how I've got all these opportunities. I have photos with n number of elite investors. Vijay Kedia sir is one of them. But again, all those kept aside, it's about what kind of value are you adding to the society. And if people see that you're adding value and you have something that they need, even if no matter how big they are, even if they know what you know, they would still want to come down and talk to you and have a word with you because they have very few people around them who they can talk to things about.
So you're already covering not many questions that I was supposed to ask you. One of them was an investing mistake that you did in your career. So you already told that you have invested in a ULIP, right? So like,
Yeah, and trust me, even to date, all my ATCs go to a ULIP. But now I'm smart enough to invest in a ULIP that has 0% allocation charges. And that gives me unlimited switches in a year. And that gives me 1010D and all those covers. I still do ULIPs because I've made so many mistakes with ULIPs. Now nobody knows ULIPs better than me, probably around me. So I mean, it's about how many mistakes can you make when you're young. But they should not cost you money.
all
They should
right,
only
all right.
cost you time.
So coming back to this main structure of today's session, people are regularly now talking about modes. What is a mini mode? So what you say about mode? I can see that probably like 5 7 years 10 years back when we started talking about modes, mode was about Coke's formula, mode was about Nestle's milk powder, mode was about Pidilites. Like these days when we talk about mode, we have several different terms. We have like mini mode, taste ka mode hai Maggie mein, and all these things. So do you also agree to all these things that mini modes bhi hote hain? For me, mode is something like, if you have a mode, then you have a mode. There is nothing like a mini mode or a taste mode or something like that. So what's your view on that?
So I tell this to everyone at TIC, and because if you don't entertain people, don't listen to you. So no matter what, even if I tell you the next 10 multi-baggers that I feel, or next 10 stocks that are going to give you 1,000% return in next 20 years, you're not going to listen to it unless I spice it up. So to entertain, while we are so deep in a dry subject like quantitative finance, I tell, when I want to describe moat, I say moat is like love. If you have to find it, it doesn't exist, right? So I don't really want to get into those terminologies of micro moat, macro moat, mini moat, and under the carpet moat. I heard under the carpet moat for Zomato, and I was like, what does that even mean? I think moat is very simple. Moat is when you go to a restaurant and you eat something and you crave for it the next day, or you crave for it somewhere down the week. That is moat. Nothing else is moat. And to be very frank, there are only few businesses I've seen moat in. Though you will like Fevicol. I have not witnessed moat of Fevicol. I mean, trust me, I am not a carpenter. I'm not a person who is using Fevicol day in, day out. Probably Fevistick. My fiance is an architect. Maybe she also doesn't use Fevicol day in, day out. She has contractors who use it. So I think when we have to quantitatively define moat, or when we have to qualitatively define moat, it is margins. It is about Porter five forces theory. It is about how can I price my product in the market, and whether the buyer is willing to pay me that margin that I'm asking or not. And if there is a competitor in the market, is he able to chew into, or is he able to take a bite of my margins? That's it. Because wherever there are margins, there'll be competitors. We have seen that through orthodox economics. If there are margins, there'll be competitors. We started together. Atul sir and I started together in investing club almost 1.5 years ago. And now, if you go to Instagram, there are clubs and clubs and clubs. Nobody knew, or when Atul sir came up with the term Together Investing Club, nobody knew there is an investment club ever. I mean, nobody thought in that way, but because of his experience, he has traveled globally, he has worked globally, because of the exposure he has, he came up with this concept. And I bought the concept, and I understood it when he explained it to me, and we took it together. But now there are margins in our business, right? There are margins in that club, and everybody is coming in to squeeze the margin. Now, my moat is if I keep increasing my price, and if the customer keeps buying my product, that's my moat, right? So when you're talking about moat, it's simply about if there are margins in the business, and if the margins are sustainable, and if the customer is willing to pay for the margin. As simple as that. So when you're talking about businesses like Asian Paints, Pedialyte, when you're talking about, let's say, cigarettes, ITC or any other business, I think moat is simply funneled down to margins that are consistently enjoyed by a particular business. So that's what I think. Apart from that, there is nothing called moat apart from food. If you ask me, food is the biggest moat, and food is the only moat. Apart from that, if finance people want to use moat here and there, I think they're only talking about the superior margins that a company enjoys.
Perfect. I'm loving the way you're answering probably difficult question in a simple way. That mode is nothing, but it is all about margins.
Yeah.
So just one last question before we start. You start your presentation. It is about changing in investing behavior post pandemic. Like probably we can say that decade of 2000 to 2010 was more about investment in real estate. Then the next decade was more about mutual fund. Probably due to last pandemic, COVID-19, 2020 and 21, probably the numbers of people investing directly into stock market has increasing is increasing every damn month. So do you actually see this change coming up, and then the complex products start coming in?
So there are two ways that I look at it. One, I'm very happy that there are a lot of people coming in. So probably if I was not introduced to a demat account by my banking RM in ICICI Bank, I would have never become what I am today. And I'm very thankful to the gentleman. He's right now with SBI. His name is Ashish Sharma. And I'm still in touch with him, right? And he's the one who got me a demat account, my first demat account. And I still own that demat account. So I think all these people who are just coming into the market, I was lucky I came in 2009 and not a couple of years before that. So when I entered, there was fancy 2 3 years bull run. I was very very fascinated by it. He bought me SBI stocks and I just sold them for 10 12 rupees profit. Another mistake that I did. Probably if I would have holded them till date, I don't know that 10,000 bucks would have been what. I've not even calculated because I don't like to put a logbook of my mistakes. I'm not that kind of guy. I would not repeat the mistake ever. When we'll be discussing portfolio structuring right now, we'll be talking about the biggest blunder of me selling SBI or biggest blunder of me doing those things. But to be very frank, people who are just coming into the markets, I think it's amazing because if there are 100 people who are coming into the markets, I'm sure 30 of them will stay, even if 70 of them leave. And those 30 are beneficial for you, are beneficial for me, and are beneficial for the entire economy, right? So there is going to be a fall off. There is going to be people who will drop their towels and who will say, oh, this doesn't work, that doesn't work. I don't care. If there are millions of people coming in, for example, I was just going through a Zerodha's post. I think somewhere around 12 million is what they're anticipating was the peak of Zerodha when Zomato IPO was there, right? Or is the peak at what they're talking about. So even if 30% of them stay back, I'm happy for the entire ecosystem. And I was just talking to someone from the Sports Authority of India a couple of days ago, and they were talking about how Olympics we don't win anything, but in cricket we win everything. And that is because of how cricket is positioned in India. How cricket is the only game that gets everything in India, all the attention, all the sponsors and everything. In the same way, if capital markets becomes that, I think players like you and me get we get to become the. I mean, if there, it's not like a boxer or a wrestler doesn't do enough practice. It's just that they don't get the platform. So I think all the people who are coming into these capital markets out of greed or out of the boreness of normal life, or I know someone who's lost their job and now they're into capital markets to make a side income. I've told them not to do it. They're still trying it. So I think they will stay and they will just give a better platform for all of us. And the people who leave is also good because probably they will then not burn other capital that they earn for their lifetime. And they will depend on portfolio managers or mutual funds or things like that. I don't know. I was just talking to a customer, and these days, when you ask a customer to invest in mutual funds, they're like, "Purani baat ho gayi, kuch naya batao," right? And trust me, the biggest investors in the world, even today, tell you to invest in an index mutual fund. S&P
Right.
500 is a golden grave. Nifty 50, Nifty next 50 is never. It's like never going to die, right? So these things, but again, I think it's about how people. It's not about how people are renting. It's about how long are they going to stay, and how can we protect them from the volatility of the market.
All right, all right. Thank you, Emmanuel, so far for answering some stupid and some very good questions. So over to you now to discuss about sectoral selection and portfolio structuring.
Sure. So I
You
have
close
a
now and you can start sharing your screen.
thank you. So I have a very weird way of doing it, a weird way of understanding finance because I'm mostly self-taught. So you'll not find, I read a lot of books, but then I interpret them in my own way because I don't understand most of them. So how I do it is I'll try and be very simple and I will try to explain you the way I explained myself when I first entered the markets. So it's very simple. When we're talking about a portfolio, two things. The first is I am a top to bottom guy, so I don't talk about businesses first and then end up realizing whether I want to invest in them or not. I'll look at the global economics, I'll look at the local economics, then I'll look at sectors, then I'll find businesses that are doing great in that sector. It helps me avoid a lot of risks, especially systematic and unsystematic risks, and position my capital fairly well in a calculated sphere. Second, I'll not be telling anything get rich soon or get rich quick kind of a scheme here. We will be only talking about how you can build concrete structures, how you can probably build a portfolio for next 40 years, next 30 years, next 20 years, next 10 years, 3+ years at least. So everything that we'll be discussing today is subjective to that you will follow it for 3+ years, or you will stick with this strategy for 3+ years. If you cannot, then I think it's not for you. How I do it is very simple. 25% of my capital is kept for trading or is kept for exploiting the market mispricing. And 75% of my capital is in concrete structures, is into portfolios that I think will perform for next 3, 5, 10, 15, 20, 30, 40 years, and probably so on. So very simple. So when KB and I were discussing about what should we be talking about when we'll be doing this session, I had only two things in mind. One was how do we select how do we select sectors, or how do we rotate between sectors, and how do we build a portfolio. So before we understand that, let's talk about the economy, because believe me or not, efficient market hypothesis is not true, right? If efficient market hypothesis was true, if the price is the real price of a business in the market, we would not be able to make money, right? Market is not efficient. That is why people like me have a living. That is why people like KB have a living. And that is where portfolio manager needed. That is where you are needed to come in and make sure that the markets try to be efficient, right? So first things first, let's try and understand of how does the economy work. So if I'm not wrong, over years, we have seen the economy goes in cycles, right? So these are the cycles through which economy goes. Now, what happens when the economy goes through cycles is there are ups and downs. And probably right now we are in the up, of course. But during the COVID, we went down and all those things. And 2009 was a down, and all those things. So the objective is very clear. When the economy is going up and down, there is a single cycle. So a single cycle for an economy is probably going to be something like this, right? So this is a single cycle, a complete up and a complete down. Now, when we're talking about a single cycle of an economy, we have to understand that within a single cycle of an economy, there are different phases, right? So there will be different phases to how economy will unlock itself, and how the entire business clustered together, and one business buying from a different business, a raw material acting as a finished good for someone and acting as a raw material for a different industry. All those things that happen around us will happen in different phases, right? So we need to understand those phases first. We need to understand how those phases occur. So let's say this is a fall of an economy, and then the economy starts going up, right? So let's say this is how it happens, and let's try to distribute the entire economy into 4 phases, right? So let's say phase 1, phase 2, phase 3, and phase 4, right? So there are 4 different phases to the economy. Now, what do I mean by phases? What do I mean by phases is very simple. When I say phases, what I mean is that in a certain time frame, it's not that the businesses would not be working or businesses would not be doing it. What I mean is in phase 1, there'll be an economy that will be doing very great in its growth phase, or it will be in growth phase. And probably in phase 2, there will be a different sector that will be in its growth phase. In phase 3, there will be a different sector, and probably in phase 4, there will be a different sector, right? So all these sectors will be at the peaks at different time frame. If you can see, all the peaks are at different time frames, right? So we're talking about the left-hand side of each peak. So what we're talking about is phase 1 being, or phase 1 businesses being in their peak, phase 2 businesses being in their peak, phase 3 businesses being in their peak, and phase 4 businesses being in their peak. So this is how you can rotate your sectors. This is how you can try and choose which industry or which sector you should be investing in, depending on what phase the economy is in. Now, if I come down and if I talk about phase 1, phase 2, phase 3, phase 4 sectors, or if we want to talk about all these, let's go ahead and try and understand of what are the different businesses that are a part of this, or what are the different businesses that are a part of these phases, right? So let's talk about phase one. So because it's not an interactive session, otherwise I would have just asked you guys to give me sectors and I would have put them in different phases. But because it is not, what I'll do is I'll try and just, because it's a monologue, I will try and put different sectors in it. So in phase one, we have banking. Of course, the entire economy is dependent on banking. If the Reserve Bank or if the central bank does not print currency and give it to banks, it cannot further distribute into the system, or it cannot give it to you, me, or probably we are talking about $6 trillion of infrastructure in US. We're talking about somewhere similar quantum or similar ratio of number in India in terms of infrastructure investing and all those things. So unless there is banking, that's the first node of the entire economic cycle. And also, blessing in disguise, it's also the last node of the entire economy. So banking is a phase one. Then we will have auto, of course. You will see auto doing great in phase one. You will have reality, and you will have infrastructure for that matter. Or probably, let's not say infrastructure here. Let's say infrastructure in phase two, right? In phase two, we will have infrastructure. So a lot of people come to me and ask about real estate, or they will come to me and ask about, oh, how does the land or how does the real estate want to do? Well, we will have to split that into two. We'll have to split that into reality and infrastructure. So probably mall is infrastructure, but house is a necessity. So if you're talking about 2 BHKs, 3 BHKs, they're a phase one kind of a thing. But if you're talking about malls, you're talking about shopping complexes, you're talking about, let's say, big office spaces, they're a phase two kind of a setup. Of course, COVID has taught us something else. We'll come to that later. Probably we'll come to anomalies later. Right now, we're just talking about normal economics. We're just talking about how normally businesses or markets operate. So infrastructure, and then we will have, of course, infrastructure will have capital goods. So companies like L&T probably, or there are more names to it. I don't want to get into names right now. And then why does this happen? Because there is a lot of government orders that go into the system. So all the businesses that have a lot of government orders will also there, and there will be a lot of private capital expenditure, right? So that is what happens in the phase two. Phase three is all about commodities, and phase three is about cement. Phase three is about steel, because of all this consumption that happens in the phase two, there will be a huge demand in commodities. There'll be a huge demand in all the things that are needed, and hence we will have in phase three, we'll have commodities, we will have cement, we will have steel, and we will have all those things that are coming in. Phase four is finally about FMCG. Phase four is about pharma. By pharma, I don't mean vaccines, or I don't mean the other thing. Of course, vaccines are a big thing now because of COVID. But even before COVID, when we say pharma, we're not talking about baby food. We're not talking about vaccines. We're not talking about all those things, right? We're talking about the extreme things, like probably somebody consuming a special drug, or somebody consuming vitamins, or somebody consuming food alternatives, things like that, right? High margin products. Because somebody buying a Disprin or somebody buying a Crocin is not a high margin product for the pharma company. But somebody getting plastic surgery done and buying those synthetics, the silicon synthetics, or somebody using cosmetics, or somebody using some other kind of special treatment or special lifestyle change or life-changing medication is a high margin product. So everything that I'm listing here is only talking about high margins. It's talking about when does a business get absolutely high margins on what business they're doing, right? And probably in phase four, we will have precious metals also. So we will have precious metals, probably gold and silver also performing in phase four. So this is how different phases of an economy. Now, what this means is not that phase one companies do not perform in different sectors, right? So if we start with phase one, it is going to continue performing until phase four comes in, right? It's just that the growth will not be the same. In the same way, phase two businesses will also be performing in phase three and phase four. Phase three businesses will also be performing in phase four. But what happens is when the economy collapses, right? Or when the economy goes for a toss, then probably phase four businesses will stop performing after a certain time. For example, you will see hotels, travel, hospitality, and all these businesses not doing that great in right now, or probably during the economic, I would not say recession or slowdown. And then probably phase 3 businesses would still further go and stop performing once further there is a slowdown. And finally, it will come down to phase 2. Ideally, what happens is by the time we are here, again, there is the next cycle that comes up, right? So again, phase 2, phase 3, phase 4, and the cycle goes on, right? To be very clear, again, we're not talking about the business getting shut and getting closed. We're only talking about growth. We are only talking about how a business grows. So probably all these green lines on the top left-hand corner are significance of growth. Now, what happens is if we understand this, we will also understand that there are 2 levels of how we build a portfolio. The first is this, of course, where we try to rotate based on these structures. The second is where we don't sell, or where we don't keep buying and selling stocks like traders of a wholesale market, right? We're probably manufacturers, or we're probably big size people who have bought good businesses and we want to stay with them forever, right? So I'm leaving this image here, and I'll probably take you to a different one, right? So now what I do is I'm transitioning you to a different level of all this. Now we're going to the wiser version of doing it, right? All this news, all this sector rotation, all this understanding of business cycles is a not so wise way of doing it. It's an intelligent way of doing it, right? And what happens is stock markets time and again prove that intelligent people lose money, right? We have had the smartest people on earth losing a lot of money to capital markets, or losing a lot of money to the stock markets and all those. The best example I have is one of the greatest scientists losing most of his money to a tulip bubble, right? And then he said, I know all the laws of physics, but I do not know laws of human behavior. That was his statement. Now, coming back and try to understand that all this is great. All this is what you will be listening on news. All this is what you'll be listening on TVs. All this is what you'll be reading when you're talking about investment reports. But this is not how a portfolio should be made. This is not how you should be investing. You should not be saying, oh, let's try and understand what phase the economy is, and let's try and invest in those stocks, right? Absolutely not, right? Because irrespective of what phase the economy is in, a business is a business. If it is profitable, it will remain profitable. The profits can shrink and the profits can expand. The business revenues can shrink and expand. The reward that the business gives to you as a shareholder in terms of dividends or in terms of compounding of the share price can go down or go up. But at the end of the day, a business remains a business, right? So I know this looks very fancy. I know probably buying a bank in phase 1 and selling it by phase 2, buying infra in phase 2, selling it by phase 3, buying Siemens in phase 3 and selling it by phase 4, and buying pharma in phase 4, or buying gold and silver in phase 4 and selling them again when the market's falling is a great strategy, right? But we as individuals cannot do all this. We as individuals, or even systems for that matter, nobody can come in and claim that I know what phase the economy is in. Nobody can claim I know exactly what sector is going to go up next, right? That is absolutely not possible. And because that is not possible, or because that is not a wise way of doing it, it might be an intelligent way of doing it, but because it's not the wise way of doing it, I'm going to give you a very no-brainer and probably a 40-year, 30-year, 25-year, 15-year, 5-year strategy, right? And what I'm going to do is I'm going to ask you to try and imagine, close your eyes and imagine of how a house is built, right? Or how a building is built, how a structure is built, right? So broadly, we can define investing into 4 categories, right? The first is value investing. So I know a lot of fans of Warren Buffett, or probably a lot of fans will know value investing, though I doubt if Warren Buffett is still a value investor. But value investing is one part of it. And then we have something called growth companies or growth investing. Then we have something called high growth. So I will be talking about growth and high growth as we go. And finally, we have speculation. So everyone who is right now investing in electronic cars, if you're an investor of Zomato, if you're an investor of Netflix, if you're an investor in EVs, of course, electronic cars, if you're an investor in the solar industry, if you're an investor in anything, Paytm for that matter, you're all speculators, right? You're all speculators. Someone who is buying value stocks, someone who is buying future cash flows discounted today and at a premium, or at a discount, at a premium of price and a discount of cash flows, is a value investor. Someone who's buying growth, someone who's saying, okay, 100 rupees of probably return on equity or return on capital growing at, let's say, 20, 25, 30% year on year is buying growth. Someone who is buying for 50, 55, 60% of growth year on year is buying high growth, right? So this is the difference between all these different kinds of investing. And it will take way a lot of time to get into them and slice them up independently, individually, and then think about it. So what I'll be doing is, again, going back to the theory of building a house. So if you're one of those guys who is building a house, what you are actually doing, or what you will actually be doing is, first thing you'll be doing is you'll be digging, right? I don't think any structure on earth, like I'm, again, probably the third time my fiance is an architect. So out of 12 years of my relationship, 7, she's been an architect. So I'm a draftsman now, not a licensed one though. So no building is possible without excavation, or no building is possible without digging the earth, right? So the first thing you will have to do if you want to build something is dig the earth. So when I say dig the earth in finance, it's nothing but research, right? Dig the earth means know your macros, know your micros, know what businesses are around you, know how those businesses are doing, what products are you using, what is the margin. So ideally, when I go to a restaurant and I ask the restaurant owner, what's your margin? And he's always on the back foot. And then I have to explain him my intention. My intention is not to kill his margin. My intention is to understand his margin, right? They're two different things. So if I know a restaurant's margin, I know if Zomato is a sustainable business, because Zomato in itself, without restaurants, is a bubble, right? Zomato will earn as long as the restaurants are able to earn. Zomato will survive as long as the restaurants are able to survive. If the restaurants are working on a margin in which they cannot survive, Zomato will not survive. So to be able to invest in Zomato, I need to understand restaurants, right? So things like that. There are a lot of correlations that go on there. So now if you're building a house, the first thing you'll have to do is excavate. Excavation is, of course, research. So after you've done excavation, which is research, of course. So before value, let me just try and write it in green, which is research, right? Now, before you do all that, or before we come in and do all that, after we have done research and before we have come into the investment phase, what is the first thing that we do? The first thing we do is foundation, right? So to any building, the first thing we do is foundation. Okay, now what is foundation? Ideally, when I ask what is foundation, a lot of finance students will come in and say foundation is, let's say, the value stocks, or foundation is Coca-Cola, or foundation is Apple, or foundation is big stocks, large cap, blue chip companies. And there are a lot of terms that they come out with, right? Now, when I take you back to phase 1, phase 2, phase 3, phase 4, you will understand that foundation is nothing but lenders of an economy, right? Because the entire economy revolves around lenders. So foundation of any economy is lenders. Foundation of any economy is its banking system. Foundation of any sustainable ecosystem is the banking system, right? So when we talk about foundation of our portfolio, we should understand that the foundation of our portfolio can be nothing but lenders, right? So when I'm not writing banks, because banks or non-banks, lenders are the foundation of a system. So when I say lenders, we're talking about big banks, we're talking about small banks, we're talking about NBFCs. We can also talk about credit card companies if you want. I try to avoid it, but there is only one business in India. I call it the American Express of India, of course. I'm not naming the business, but if you're smart enough, you know what business it is. So when we're saying a portfolio, the foundation is lenders, right? Lenders are the bedrock of any given portfolio, and they should be the bedrock of any given portfolio. If they're great lenders, they're a great foundation. If they're weak lenders, it's a weak foundation. If they're poor lenders, you have a poor foundation. As simple as that. Now, why is foundation lenders? Because you cannot change them every now and then, right? You can probably break your walls, you can probably do anything you want, but you cannot break your foundation and try to do it every now and then. That is why when I said this portfolio is 5 years, 10 years, 15 years, 20 years, 25 years, I would like to say a 40-year portfolio if you're trying to build one, right? So foundation. After you've built the foundation, what do you need? You need pillars, right? So probably you need, I'm just drawing 2. So probably you need pillars, right? And when you need pillars, pillars should be strong as well, right? So when you need pillars, what are pillars? Pillars are ideally value investments. So pillars are the companies that are giving you good cash flows, there are free cash flows, there is consistent compounding happening to their equity. They know they have so much cash, even if the world changes the way they consume, they can venture into new businesses, right? you will see a lot of businesses who have a lot of free cash flow changing overnight and still being profitable because they're sitting on such cash pile. They can change their business methodology, they can change their business sense, they can do what they do overnight, right? For example, when Pepsi wanted, of course, there are a lot of Coca-Cola fans because Warren Buffett invests in Coca-Cola, but I'm a bigger fan of Pepsi because it ventured into alternate drinks way ahead of its time. It ventured into healthy drinks. It ventured into alternative to soda. It ventured into alternative to sugar syrups, and it's probably has a huge portfolio of healthy offerings now. And I don't know about a lot of people, but not me, but a lot of people around me are very health conscious now, and they're consuming these products that are provided by Pepsi, which are better than drinking Coke or better than drinking Pepsi itself, right? So value investing is the pillars of your portfolio, right? And you can ideally go back and you can look at blue chips, large caps, small caps, mid caps. I don't care which cap. It should be a value investing stock. It should have free cash flow. Its free cash flow today should be priced higher than the market price, and it should be a premium business. It should be a business that is a tick on all the Porter 5 Forces model. Has great margins, has very low or negligible debt. All those things are said and done, right? All those things are unsaid. If you're finance guys, you understand it already, right? And then after we've built pillars, what we're building? We're building walls. We're building we're building walls. We're building I don't know what it's called, slabs, things like that, right? So now when we're putting all this is basically nothing but growth investing stocks. And when we're building walls, it's nothing but high growth, right? So that's how the structure is built, right? So again, lenders are the foundation of your portfolio. Value investing are the pillars of your portfolio. Growth and high growth are the beams or slabs and the walls of your portfolio, right? That is how it is. Finally, after the house is entirely ready, what do you need, right? Now my house is ready. What do you need? So if trust me, if it was me, a house is what it is right now, right? In its shape, because I'm not a great consumer, I'm a great investor, right? But ideally, not everyone is, right? Probably my fiance would not let me, or not, we will not live in a house like this. We would need a TV, we would need a fridge, we would need beds, we would need cupboards, we need toiletries, we need a WC, Jaguar, and plumbing and all those things, right? Now, all these things that go into a house, for the sake of it, I'm just making a chair, probably, let's say. All these things that go into a house are nothing but speculation, right? Okay, so now we've understood of how a portfolio is built. Now it's very easy to understand of what you should be changing every now and then, and what you should not be changing every now and then, right? So you cannot get rid of your pillars, you cannot get rid of your slabs. You can absolutely get rid of your walls whenever you want, right? You can get rid of the paint on your walls. You can get rid on how the wall looks. You want a new window on the wall, just ask someone to come in. India being a cheap labor economy, ask someone to come in, pay them 2,000, 3,000 rupees. They'll cut out a beautiful window in your wall, right? All the bricks gone and a new glass fit and UPVC and all those things. So the objective of trying to correlate these two is so that you remember, right? So that you remember of how a portfolio is built. And when the markets fall, right? When the phase 4 is over and when the markets are falling again, you understand of what stocks should you sell, what stocks should you hold on to, and what stocks should you add up, right? Ideally, when markets fall or when markets are going up, people ask, buy, hold, or sell, right? And I don't understand it because I work in a very different way, right? So now coming back to this, if markets fall, or if you have to sell this house, or if you want to change this house, you want to renovate this house, the first thing that you're going to get rid of is speculative stocks, right? The first thing you're going to get rid, or the last thing, it's basically last in, first out, right? Whenever we're trying to build a portfolio, it is last in, first out. So speculative things or businesses that you're bought on speculation, again, coming back to the examples, Zomato, Uber, of course, not Facebook today, but when it was an IPO, probably all these companies that do not have an EBIT, all these companies which do not have a net profit, these are speculative stocks. So when the markets are really going to crash, these are the stocks that will crash seriously bad, because people have not bought them as foundation of their portfolio. People have not bought them as pillars of their portfolio. They've just bought it for alpha. They've just bought it for an additional profit margin, an additional percentage increase in their portfolios, right? The first thing the smart investors are going to sell is speculative stocks, right? The second businesses or the second line of businesses that smart investors are going to sell is high growth stocks, right? The third they're going to sell is growth. What they're never going to sell is value and lenders. They're never going to sell great value stocks. They're never going to sell great lenders. In fact, if a value stock comes down, if everything is great fundamentally, if qualitative and quantitative analysis is all green checks, and if a value stock is falling, probably while it's on its way going back, investors will also allocate more capital to value. If there is a great, amazing lender, of course, you can take names. HDFC is one of them. ICICI is one of them. Bajaj Finance is a great lender. These great lenders, when they fall, people don't sell them. People only buy. And I'm not talking about you and me. I'm talking about smart investors. I'm talking about people who are sitting on thousands of crores of capital, both in terms of in terms of deployable and in terms of the power that they can raise in the markets. So the reason I'm trying to correlate this house to a portfolio is so that you understand of how you should be building a portfolio, how you should be maintaining a portfolio, and how you should be disrupting your portfolio, or how you should be getting out of a couple of strategies or getting out of a couple of businesses. Again, just to wrap up in a very quick sense, do not buy a business that you don't understand, right? This is something everyone says. What I say is do not buy a business that doesn't understand you, right? For that being said, if I'm not a great consumer or if I'm not a great admirer of a particular business strategy, do not buy it simply because someone else is buying it, right? You don't buy things. I have a dual screen system, right? So you will have to choose your priorities. You will have to choose of where exactly do you want to allocate your capital. And every portfolio should be made based on how your psychometric is, based on how you as a consumer are, based on how your risk appetite is. And it should be customized to a level where you're absolutely comfortable and you can sleep with it overnight, right? Any stock in your portfolio should not give you a sleepless night. That's a rule I've always had. That's a rule I'm always going to have, right? Irrespective of what kind of return it can give me, I don't care. I should be able to sleep better so that I can be back in office on time, so that I can research well, so that I can deploy my capital and my resources, right? So I hope this exercise helps you and it brings clarity on how a portfolio is built, how you can actually move between sectors, and how exactly should you be deciding on when to buy and when to sell or when to downsize on your portfolio. If you follow this structure, if you buy in this order and if you sell in this order, trust me, market cycles will be ineffective on your alpha or will be ineffective on your returns. Because when the markets will be high, you would have already sold speculative high growth and growth. And when the markets will be low, you will have already accumulated value and lenders, which are going to give you a significant increase in time, right? So this is an all-weather kind of a strategy. This is probably something that I have been following for the last 9 years. It has given me great returns. It continues to give me a solid spine to my portfolio. And this is how I do it. I'm most welcome to feedbacks. I'm most welcome to any questions you have. KB can share my email ID with you guys. You can write me down. And this is how it is. So KB, I hope that helps. I hope it is not too much to digest over 20 minutes or 30 minutes.
It was literally perfect. And in fact, I'm actually confused at this point of time. Just thinking about Emmanuel Suraj, whether he's a good sales guy, whether he's a good investor, whether he's a good trainer. So, Emmanuel, hats off to you. The way you have actually simplified portfolio structuring is just too good. People out here just want to know couple of examples. You have already told what do you mean by a lender. So, what do you mean by a value stock or a high growth, or speculation? Everybody knows, like probably a Vodafone or Zomato. So, give us a couple of examples.
Sure. So, when I say lenders, okay, very simple. Look at Warren Buffett's portfolio. Or look at Marcellus consistent compounders, or look at Abacus portfolio. All these portfolios are available. It's their public information. Look at these portfolios, and when you look at them, don't look for tips. Don't look for stocks that you want to invest in. Look for knowledge. Look for information in how they're structuring their portfolio. Right. So when we say lenders, People are investing in lenders that have great distribution networks. People are investing in lenders which are probably the top 5, top 6 banks of, or top 6 lenders of your ecosystem, right? Why? Because as simple as that, lenders are backed by the central bank in any economy that you go, right? All the lenders have the same rules. All the lenders have similar margins. So how is a lender, like KB and I were discussing, have a moat over the other? It's simply the distribution network, right? So when you're talking about lenders, look at great banks, look at great non-banks, look at institutions that are very aggressive in their lending. Also, on the other hand, have a very good risk team, have a very good recovery team, have a very good probably. I generally, when I go to forums, I hear people talking about NPAs. I tell them NPA is not a problem for investor. NPA is the problem for the economy. As a shareholder, our problem is provision. Our problem is GNPA, right? And people try to miss that difference. But examples again, when I talk about value, probably you can talk about companies like ITC, VST Industries. You can talk about Bajaj Auto. You can talk about Hero MotoCorp. There are a lot of businesses when you say value. Just try and make sure these businesses also have a sentiment. You will find a lot of value businesses that do not have sentiment. Price multiples of 6, 7, 8. These businesses have very low investor confidence. For example, if you're very new to value investing, the first stock you will come across will be Coal India, right? And then you will probably come out with that slip and you will say, oh, KB, oh, Emmanuel, I found an amazing stock. It's called Coal India. It's debt free. The promoter holding is great. Absolutely fine. But is there an investor sentiment? Is there investor confidence in the business, right? So when we're talking about value, try to mix it up with whether there is investor confidence or not. I think there are a few names that I've named. There is a huge list. Trust me, on around 23rd, 24th March 2020, there were around 52 to 53 stocks in value out of Nifty 500, Nifty 350, sorry. And right now, I cannot find 12. I cannot find 10 stocks in Nifty 500 which are value, right? All of them have fairly value. We launched Together Investing Club on 16th of March, if I'm not wrong. And we can show you our books, our trade books. And I've been very open about my trade books because like Robert Kiyosaki book, Fake Teachers and True Teachers, I think what I tell you is what I'm doing in my real life. And it's making money for me, so it should make money for you. If it's not making money for you, there is something that you're not doing right? And then you can come back and ask me what it is. So the objective is we were buying heavily on 23rd and 24th of March 2020. Why? Simple. We were getting in 1 rupee of earning for 17 rupees and 80 paise of spending. And in a bank, we were getting 1 rupee of earning for 16 rupees of price. Right? So stock market, which grows at a quantitatively higher rate, was giving us a bank rate. It was a no-brainer, right? So value investing, of course. Then if you're talking about growth, we can talk about stocks like Britannia, Nestle, we can talk about Marico, and all these businesses that have their break even, that they have ROE to P break even of 3 years, 5 years, less than 5 years. If it's beyond 5 years, let's say 7 years, 8 years, 9 years of ROE P break even, then probably you can talk about high growth businesses. Again, it gets very technical when you go into growth and high growth. As simple as that, if time permits, KB, I just want to give one more example.
Sure.
Yeah. So let's say this is a gentleman. I'm sorry, now I'm not using the pen, I'm using the mouse. So probably, let's say this is a gentleman. I'll switch back to the pencil. So let's say there's a gentleman and he just enters the platform, right? And probably, let's say this is the platform, okay? And the train has already almost left the platform. It's half left, okay? And then there is another train that is still standing on the platform. And then there is a train that is almost 3/4 out of the platform, right? So there are 3 trains that the person can run and catch. Now, because I can only ask KB, what is the safest train to catch? A train that has left the platform 3/4, a train that has left the platform half, or that is still resting on the platform?
Right there in front of me.
Right there in front of you. Absolutely. This is value investing. This is growth investing, and this is high growth investing. As simple as that. You are paying a higher premium to buy a business that you are late on buying. Somebody else has already boarded the train and the train is about to leave the platform. Now the objective or the reason is these are faster. Yes, this is not even started yet. You will have to think in your mind can you run and catch this train? Will you get hurt in the way? Will it happen that while you're going and running the train, will you fall down? Will you hurt yourself? These are the things that you generally think when you're on the platform. In the same way, when you're in the capital markets, what you need to think is, if you invest in a high growth business, when it has left three-fourths of the platform, is there a chance that you can lose capital? Is there a chance that the sentiment part of this business is going to come down significantly? Earnings are way behind the price. So will it happen that the earnings will catch up the sentiment, or are the sentiments going to fade off? These are the only two questions you need to ask. If the earnings can catch up, it's a growth investment. If the earnings cannot catch up, and if the sentiment is still high and the earnings probably can never catch up in, let's say, a decade, or let's say 7 years or 5 years, then it's a very high growth investment. So the difference, trust me, you cannot define names. So I cannot say ITC is a value investing. Probably tomorrow ITC, like we all are listening to rumors. I also listen to a lot of rumors. Probably if ITC splits all its businesses and gets independently listed, maybe the value of the entire umbrella soars to significant levels, and ITC tomorrow becomes high growth investing, right? For example, I have a wonderful example when I generally share with people. I bought all the stocks that I hold of Nestle today when Maggie was banned, right? I still remember I was in a statistics class, and the statistics teacher was teaching something. I was in college, and Maggie just got banned, right? And I went up to her and I requested if I could access my laptop. I went to the last table for the first time in my life ever. I opened my laptop and I bought all the shares of Nestle possible that I had in my account. So every penny that I had in my bank was invested in Nestle. That was a lifetime opportunity to buy a high growth stock at probably a growth value, or probably it was not value even then, probably around growth levels, right? So things like this keep happening. Businesses keep moving between value growth and high growth. Speculative businesses turn into high growth and value. For example, Facebook, when it acquired Instagram, when it acquired WhatsApp. So today's Facebook is no longer speculative. Facebook is high growth. When Google acquired YouTube, Google was no longer speculative. It was high growth, right? So all these businesses will keep moving between these technical terms. You don't have to actually understand the terms. You have to understand the business. And trust me, irrespective of what background you come with, whether you're a finance guy or not, whether you're a lawyer or you understand investment banking or not, if you simply use common sense, if you simply use your motor skills, the five senses or the six senses that God has given you, and you put them to your best use, you will be a great investor, right? All you have to do is understand the business and compare it to how safe and secure it is for you to be able to invest in.
All right. So probably we can also see the human side of Emmanuel sitting in a college class and probably concentrating more on mobile than probably the statistics class, right? All right. So, Emmanuel, moving down to the question that we have received from our audience, I will first take that from the people who have registered. So, a couple of them have actually asked about the cycle of our sugar industry. So, before I ask you the question, let me explain what exactly is happening in sugar industry. What are the following updates? So, what is happening in sugar industry is that probably farmers getting sugar canes and depositing into the mills, and then whatever sugar industry is doing that, they have three stages of filtration: A, B, and C, right? So first A, then B, then C, and after the C state, probably no more sugar can be extracted, and then rest can be used for production of ethanol. So how does the cycle happen? In fact, say for a particular year, the production is very high, so the inventory is piled up. When the inventory is piled up, there is delay in making payments, though it is a mandate of doing a payment in, I guess, 12-14 days, but most of the time it is delayed. So when the payment is delayed, farmer starts switching to different crops, easier crops, and then when next year you don't have a good production, the production is low, when the sugar prices rises, that's where they make their money. So till a couple of years back, it was only allowed to manufacture ethanol only after stage C. So what has happened? Government has allowed to manufacture stage B, because after stage B, there are two things you can do: either manufacture sugar out of it, or you can go towards ethanol side. So government has actually allowed that you can manufacture ethanol after B, and then after this, I can actually compare it with the scenario of what is happening in Brazil. So Brazil, 27% of blending. This program is actually called ethanol blending program. In Brazil, it is allowed up to a percentage of 27%. And that too, ethanol is actually priced very close to the crude oil prices happening in the global market. So what is happening is, पहली चीज तो गवर्नमेंट ने ये करी that probably after stage B you can manufacture ethanol out of it, and then they also give soft loans for that. So they are also giving various kind of moratoriums, and then subsidies are also passed on. GST is also reduced from 18 to 5. So government was actually planning for EBP program, that is ethanol blending program, to reach 20% by 2030. Now it is targeting to complete it by 2023 or 2025. So that is where our industry is actually gaining control. That probably the margins which were actually staying, I guess it was almost on the range of 5 to 6%. Sugar industry was operating. Now the margin has increased. The negative side of this is the prices are still controlled by government. Your ethanol is still not linked to crude and logistics, and there is a huge procurement cost. So now the question is up to you, Emmanuel. People are asking that how to know. Sorry, this is not the question. Just give me a second. Yes. How to know when to exit the sector like sugar, which is already 2-3 cycle this year? Continue or we should exit?
Okay. So thank you, KB, for addressing all that. One important fact that I would like to share today is, my secret sauce, if I would want to say. Just follow the earnings. If the earnings are going up, keep buying stocks, keep invested, stay hold, stay buy. If the earnings start dropping, and if the margins stop dropping, and it's mutually exclusive. If any of them starts dropping, just sell. Right? You don't have to actually think about when should I buy, when should I sell. If you focus on earnings, most of the times what happens is people are focused on sentiments, and when you're focused on sentiments, you don't know. I mean, trust me. The kind of news that we are going through globally, I don't think you can try to predict human behavior. Nobody can, right? People killing each other after marriage and news like that. I mean, I'm talking about extremes. You don't know what the person next to you is going through. How can you try to analyze, or how can you try to predict what the market is going to do, or what people around you are going to do, or what the Indian economy is going to do, right? As human beings. I think the best way to address this is catch the earnings very early and exit the earnings the moment they start falling, both in terms of margins and in terms of revenue. Sugar specifically, I entered sugar in 2018, and the only reason I entered sugar is government got rid of export duty on sugar in 2018. And when government got rid of export duty on sugar in 2018, it was great news, because globally there is a lot of pressure on India, especially because we export a lot of sugar to China, and there are trails, or there is report that says China further exports to North Korea, and North Korea we all know is a no trade zone and all those things like that, right? Now the objective is, if the sugar export duty has been got rid of or has been removed, it is simply going to make sure that sugar producers are going to export it, because we were seeing, like KB said, MSP was a very big problem for all these sugar producing companies, because in a certain specific time, you have to consume the sugar cane and process it into processed sugar. If you do not do that, it converts into ethanol and all those things. But the moment we got rid of sugar export duties, we've suddenly given a superpower to a sector. We've suddenly given superpower to an industry, right? And it's not like we are great exporters of sugar. Even today, if you see, one of the finest sugar exports is from India, right? We have one of the, look at the entire belt from Punjab to end of Uttar Pradesh. I mean, it's all sugar canes all around, right? So again, that follow the earnings. 2018, we got the first green shot on EPS, earning per share. As we speak today, I'm looking at top 4-5 companies in the sugar. We're talking about an average EPS of 22-23 rupees per share, and we're looking at a price to earning multiple of 16, right? So it is not expensive even now. Even now, you could probably go ahead and buy the top 4 or the top 5 great sugar companies. I'm holding 4 of them, right? I would not like to name all 4 of them, but I'm holding 4 of them, and it's been since 2018 that I'm holding all 4 of them, and they've given significant returns. And I don't want to exit, even if they've given, let's say, to be very frank, if I look at them right now, I think they've given me somewhere around 120% return. I don't want to exit them simply because the earning multiple is still 16, right? Simply because even if the prices have gone up, the earnings have also gone up, right? So let's consider it as a house. A house I buy for 1 crore, the rent today is, let's say, 30,000 rupees a month. Tomorrow, if the house becomes for 2 crores and the rent has also gone up to 60,000 rupees a month, KB, should we be selling that house?
Not at all.
Not at all. If the house goes to 2 crores, but the rent is the 30,000, now should we be selling the house? Absolutely. Right? And if the house has gone from 1 crore to, let's say, 80 lakhs or 75 lakhs, and the rent has gone from 30,000 to 25,000, should we be selling the house? Yes. So me buying, selling, or holding the house is not dependent on who is paying me how much. It is dependent on what rent am I able to generate month on that house. In the same way, me buying, holding, or selling a business or a stock, for me it's a business, should not be dependent on what is the price National Stock Exchange and Bombay Stock Exchange is trying to tell me. It should be dependent on what is the earning that the business is able to generate for me as a shareholder. Because at the end of the day, the free cash flow, the dividend is what I am there for in the market. I am not there for. I would not say I'm not there for capital gains. Of course, it's a major part of what I do, but I should not be chasing capital gains. Capital gains are like cats, right? If you have food, the cat will come to you. If you chase the cat, it's not going to come to you, right? So I think for these sectors, especially, I know a lot of people will be asking about cement. You'll be asking about steel. You'll be asking about all these sectors that are lately going great. Keep them as long as the earnings are going up. The moment you see earnings or margins eroding, time to exit, time to be cautious. For example, I'm very cautious in IT as of now, right? And if you ask anyone, if you ask a newcomer into the market, he will say, "Oh, IT is amazing. Infosys went up 20-30% in last 3 months. TCS has gone up, Wipro has gone up, Mindtree has gone up. Happy Minds as an IPO has rewarded so many investors so much." But the latest earnings, when you see, or the latest reports that you see, margins are shrinking. And if you look at people around, if you look at IT professionals, they're getting paid more than bankers. They're getting paid more than, I'm not comparing them to me, but they're getting paid more than other industries. And that is simply adding pressure, or that is simply giving pressure to the IT firms. Except for, let's say, the two TCS and Infosys, they are also under pressure, right? So people are moving companies, people are getting paid obnoxiously well, and things like that. And I think that margin pressure is also pressure on me as a shareholder. At the end of the day, I want to see what the bottom line is. I don't care about the top line, right? So to answer your question, KB, follow the earnings. The moment you see earnings dropping, the moment you see margins dropping, exit the business. As simple as that.
All right. And just to add to your IT thing, probably IT is also a game of a margin. Say if Infosys is making a project today at 20%, and when the that contract expires after 3 years, and TCS is offering them at 16%, they will go to TCS no matter what, right? So it is a margin game actually. Yeah. So a couple of quick fire questions with you. Is identifying multi-bagger is easy or sticking to it?
So trust me, nobody knows a multi-bagger. Even if God comes on earth, in what I am an atheist, but even if God comes on earth and says, "Okay, man, this stock is a multi-bagger," I have learned by burning my hands through a lot of tips and a lot of external research. I will not buy that without internal research, without in-house research. It should be either researched by me or by my team for my money to go in. So trust me, nobody knows a multi-bagger. Nobody knows a particular stock is going to become a multi-bagger. And that is why I don't like the name multi-bagger in itself, because it's too late. By the time you say a stock is multi-bagger, you have missed the bus. The train is already not 3/4 out of the platform. It's probably on its next station already, right? So Bajaj Finance, people say a multi-bagger. Havels, people say a multi-bagger. Ho gaya, khatam ho gaya. Ab aage kya? And then people say, "Oh, now we want to find the next Infosys. We want to find the next Bajaj Finance." Possibly nahi hai. Right? You cannot find the next Infosys. There is no next Infosys. There is no next Bajaj Finance. It is not going to stay cuffed. It is going to do its best to try to keep its margins. It's going to do its best to keep its revenues up. Right? So the objective is, when you're saying multi-baggers, They are multi-baggers if someone has holded them. For a fool like me who bought SBI at 2 digits or probably early 3 digits and sold them for 10 rupees, it's not a multi-bagger, right? For someone like me who bought ICICI securities on IPO and probably sold it for 20-25% profit, it's not been a multi-bagger for me, right? So objective is it's a multi-bagger only if you hold. How many of you can hold? That's the question that you will have to ask yourself.
So sticking to it is the real problem, right?
Sticking is to it a real bagger. And again, you cannot say a multi-bagger is a multi-bagger without earnings. Catch any multi-bagger historically, 10 years, 20 years, 25 years, 30 years, 15 years, 5 years, 3 years, कोई भी multi-bagger को पकड़ो, apart from few names which I'll not take, which are sentiment-based multi-baggers. If it is been a sustainable compounder, it is simply on margins, it is simply on earnings. There is no other parameter for a multi-bagger to be a multi-bagger. If earning per share has not gone up by 10 times and the price has gone up by 10 times, it is going to fall. If the earning per share has gone up by 10 times and the price has gone up by 10 times, it is going to be sustainable. As simple as that. That's the thumb rule, right? If my bottom lines, if my margins have been intact and if my EPS is going up, only then can the stock price go up. As simple as that. So all I'm looking at quarter on quarter, year on year, going through the management reports, going through the annual books, going through the forensics, going through the auditor report is simply to figure out whether the earnings are genuinely going up and whether the margins are genuinely going up. If any of them are not, great. So far the relationship was amazing. Now I will have to take an exit. As simple as that.
Okay, so quick fire, rapid fire questions to you. You need to choose one of them, right?
Okay.
You need to pick your stock. SGFC or Kotak?
HDFC.
HUL or ITC?
ITC as of date.
AU or Bajaj?
Bajaj.
Alkyl Amine or Laurus Lab?
I have not invested in both the businesses, so I don't know any of them. Anyways.
Okay, a very famous and a tough one. Asian Paints or Berger?
Any day Asian Paints. Any day.
All right.
I'll take this example. Just 2 seconds. Look at the top management of Asian Paints. Look at the top management of Berger. 60% of the top manager of Berger is ex-Asian Paints.
Absolutely.
As simple as that. Why would I want to invest in something that does not have a human resource team to find the next big talent, right? It is hiring people who hires the best talent in India or probably in the world in the paint industry, right? Asian Paints probably hires the best talent in the world in the paint industry. I would go with Asian Paints. And there is no valuation gap. You will see Berger and Asian Paints have no valuation difference. They're almost at the same valuation difference.
Almost same. Then probably PE ratio of Berger Paint is higher than Asian Paints. Slightly higher, but it is.
Not even P. I mean, if you talk about free cash flows and other parameters also, they're very closely linked. So I think both of them are almost same businesses. I think both the managements are also very close. Both the teams are also very close. It's like two brothers in the same business. Trust me.
That's why I said it is difficult. You made it sound simple, but it is actually not that simple.
Yeah.
Okay. Next one. Nestle or Pidilite?
As of date, Pidilite.
Astral Pipe, Supreme.
Pipes.
Nifty, Junior Nifty.
As of date, Nifty.
Large cap, Flexi cap.
Any day large cap.
Debt fund, arbitrage. This point of time.
Arbitrage. Again, because it gives you taxation benefit of equity. In debt, you will end up paying a lot on taxation.
Right. Small case or a PMS?
If you can afford a PMS. If you cannot afford, you'll have to go with a small case.
So to all my viewers, this was probably a trick to get some names out of Emmanuel Suraj. You have got it. Try and do your own research and investing into those stocks. So one of the questions from the registered trainees was how to network with people in investment and trading industry and how to connect with fund managers for internships. So probably half part of that you have already answered. So if you can elaborate a little.
I think the best way is try to be their customers. Nobody says no to a customer if you can afford. If you cannot afford, try to add value to what they're doing. Trust me, everybody makes mistakes. I make a lot of mistakes. And my team is the best filtration mechanism I have. I work almost. I don't want to brag, but I have to work almost 10, 12 hours a day. And when you're stretched like that across different hats and different roles, you tend to make mistakes. I make a lot of mistakes. My customers know that. My team knows that. People who work very close to me know that. My family knows that. If they have to meet me, they have to block my calendar. I will not remember it, right? And that doesn't say I'm very important. It simply says I'm not as good as I look on the screen, right? I have my own issues. Now, if there is a portfolio manager that is public about something, and if you can find mistakes in them and not rub it to them, but try and also give solutions, right? For example, if in this entire presentation you find something that I would have done a blunder at, and it should not be like spelling errors or pronunciation errors or things that do not matter to the world. It should be core finance, a problem that you have solved for me, that can inculcate respect in me for you. If you can do something like that, it will be amazing. I mean, trust me, I've written emails to top shots in the investment world across. There is a Russian data scientist that I wrote to, and he reverts. There is this there is a there is a professor of behavioral finance based out of Singapore, and I write questions, genuine questions that I really need answers for. It should be genuine. It should be actual problem. It should be something that you're very passionate about. Trust me, people like KB can make out whether you're writing that mail to get attention or whether you have content in that mail, right? We can make it out now that we. I probably get 20-25 mails a day in my important mailbox, right? So I don't have more than 10 minutes to scan through them, right? You should be able to draft a mail that goes in my star box, right? It should have that kind of quality. If you can do that, amazing. Apart from that, try to get internships, try to get things like that. All houses, we are always looking for great talent. Apply to A3D, apply to Together Investing Club, apply to KB's. Just don't put your CV there. Give us a story of why we should be investing in you. Why should be and investing in you means time. There is so much time that goes into training a resource, right? So make sure you're genuine. Make sure you have enough content. Make sure you can add value to Emmanuel, Suraj, to KB, to Saurabh Mukherjee, to a big firm. And trust me, nobody is going to turn you down if they see that you can be profitable for them. Not monetarily, even if you're a non-monetary beneficiary, you're most welcome. I think the best way to do it is build content, build yourself as a resource, and then showcase yourself as a genuine person. We do not have space for non-genuine characters in the financial industry. Trust me, clients know you're not genuine. People know you're not genuine if you're not. Clients know you're genuine. People know you're genuine if you are. So just it'll take your own time, but don't try to fake it out. Try to build content first, then try to showcase it to the world. And the moment you do, you will be seen. There are a lot of eyes looking around for great talent. Trust me, I am dying for great talent day in, day out. Half of my job is finding great people, right? And if you are a great person, I want you more than you want me. KB needs more great people than you need KB, right? So just be genuine about what you are, who you are, and what you would want to do in an organization. And I think most of the PMs, most of the great funds are more than warm and welcome.
Absolutely right. And just adding to it, we know when you're faking it. People making paper trades and publishing all those details. We actually know we have been doing this for last 15, 16 years. We know what is a paper trade and when you're doing it actually. Right. So coming down to live questions from our YouTube live stream, there are two type of audience there. One, I would like to say hi to your mom. Auntie, you're not only you are proud, thousands and lakhs of people are proud on Emmanuel Suraj. So hi to you and hi to everybody in my family putting down all those comments. Coming down to actual questions, there is somebody by the name of Sanjeev Gulia, and he's asking if you have knowledge of viewing chart patterns means good in technical analysis. How can we trade that same in FNO and means how to choose SP? Please give some knowledge on that.
Sanjeev, very simple. Derivatives are weapons of mass destruction, by what it has been said by the Oracle of Omaha. But to be very frank, they're hedging instruments. And what you have to do with hedging is very simple. What you want to do tomorrow is what you do today with the hedging instrument. For example, if I am very positive about Infosys, and if I don't know charts that well, I'm not a chartist, I'm not a technical analyst. I do look at charts, but it's only for triggers. It's only for confirmations. I don't use charts for actual decision system. I use charts as decision support system, right? So,
Absolutely.
yeah. So if you can look at charts, trust me, a lot of people claim they can, but uh, I have not seen their strategies giving profits. Also, the problem with charts is it comes with a lot of cost of execution. Trading comes with a huge cost of execution, with which you don't realize. Investing comes with zero cost of execution. I don't have any cost of execution if I want to invest, right? The cost of execution is very low. Now, answering your question, if you want to take a derivative position, just make sure whatever you want to do tomorrow, you're doing today. So if you want to buy Infosys tomorrow because it's going to go up, buy today. If you want to sell, let's say a particular stock, I'm not a shorter, so I don't know what stocks you can short. But probably let's say if you want to short the Japanese yen, or if you want to short the US 10-year government bond, which right now a lot of people are, just buy the derivative today. So sell a future today if you want to do it tomorrow. As simple as that. And I would say, Sanjeev, by your question, I understand that you're very new to the markets. Try to not do derivatives for at least the first 3 years that you're in the market. And I didn't do derivatives until I think 6 years of my presence in the markets. And when I wanted to venture into derivatives, I went to Indian Institute of Management, Ahmedabad. I spent 2 weeks there. I learned option strategies, the theory of it, the practical of it. I bought a software that teaches on how option strategies work, on how option payoff work, and then I started doing it, and it helped. I would have either lost that money in derivative strategies and learned, or I would have invested that money and learned. The only thing is, when you lose your money, you also lose your confidence. You can earn the money again. You cannot earn the confidence once you've lost, right? So if you're new, if you're trying to venture into stock markets, try to refrain from derivatives. If you're young, you have the entire life in front of you. You can compound your money at a significant rate. You don't need derivatives to compound your money at a significant rate, right? Unless and until you're short, do not take derivative positions. Try to refrain from them, especially buying options. I know a lot of people who buy options and make no money, but the kick of it, the feel of it, the adrenaline rush of it brings them back to the options market. It's like a casino. Try to stay away from derivatives. Try to understand the markets first. If you do not understand the markets, you will never make money in the derivatives. So if you don't know if the Nifty is going to go up tomorrow or go down tomorrow, no matter how great you understand puts and calls and put call ratios and option chains and straddles and strangles and all those things, you cannot make money, right? So I would say try and avoid it. If you still want to, whatever you want to do tomorrow, do today.
Okay, so moving down to next question. Somebody, uh, she's my student only. Simran thinks that you're a god, and he thinks, "Hi sir, can you tell me when is the right time to exit from market and face no crash?"
What is the right
You're a
time
god,
to
right?
exit the market and
Face no crash. You're not facing a crash, and just you exit the market. You know that tomorrow onwards market will crash.
uh, very simple, Simran. If you see earnings going down month on month, quarter on quarter for a particular business, exit the business. Nobody can predict a market crash. Market crash comes with a lot of triggers, a lot of human psyche, and a lot of human behavioral shift or the understanding. So, crash, I don't, everybody has their own definition of crash. For someone, 2% is a crash. For someone, 20% is a crash. For someone like me, 60% is a crash. 40% is where I start buying. High growth to value and high growth to growth and growth to value. That's at 40%. So trust me, if you follow your businesses, if you follow your businesses that you have invested in, and if you see earnings are falling and margins are falling, you should start exiting them right now. You should not wait for a crash. But I think the best way to avoid crash is to sell during the crash, when the crash is actually happening. I tried to do it. The 2019 crash was one of the first crashes that I have witnessed. Markets have never fallen like they did because I entered in 2009. So 19 was my first everyday red candle kind of a situation. When most of the stocks
Every day a bigger one.
yeah. So and I tried to sell stocks again. Going back, I sold speculation, I sold high growth, I sold growth. I added on value and lenders, and that is why today I have made more money than anyone who was trying to do derivatives or who was trying to do. Trust me, I don't do derivatives, and still my return on capital is or return on invested capital is almost similar to a derivative trader, right? And that is because over the period, the rate at which I am wrong is less than the rate at which a trader gets wrong. As simple as that. So don't try and predict the crash. Don't try and wait for crash and all those things. Just stick to your businesses. If your businesses are doing great, even if the sentiment is losing, even if the sentiment falls, try to catch hold of the earnings. When the markets bounce, you will make a lot of money.
All right. So before moving on to next question, everybody who is live, please subscribe the channel. All right, so that you can see Emmanuel once again. Emmanuel, the next question from is from Triviwan. He's asking, what is your view on global dollar index? According to me, it's in bear market, which will basically lead to increase in commodity price and will be good for material and commodity stock.
For the first time in my life, I'm buying gold and I'm buying some silver for the first time in my life. And probably someone who knows me from college will be laughing right now because I've been a great advocate of not buying precious metals because they act as they don't let the currency rotate in the economy. I buy gold and the money does not rotate in the economy. That's the problem with these elements of or these instruments. But yes, the dollar index is bearish. But I respect a lot of people in the industry, right? For example, I learned this very late in my life. If there is something you don't know how to do it, ask someone who is old enough and who has done this a lot of times in his life. I respect a lot of people in the industry and they're very bullish on dollar right now. They're very bullish on US as an economy. They're very bullish on dollar. They're bullish on not the dollar index, but they still have their faith in the US government bonds. They still have their faith in dollar, right? I know China is behaving naughty. I know the kind of things that they're trying to do. They're buying mines and they're trying to deallocate themselves from dollar and all those things. To be very frank, I think right now is not the time when we can look at a dissemination in global power. Right now, we're looking at someone to lead the world. The entire world is in a situation where we are clueless. Especially we are clueless, right? In India, most of us are clueless. What business should we do? What should we be doing? A couple of my clients 3 years ago would say, हमें stock market में पैसा नहीं लगाना, हम अपने धंधे में लगा के कमा लेंगे. And now they are the same people who are selling their businesses and giving me the money, right? So that is the transition people are going through, and it's not a good thing. It's a very bad thing because unless they were running their businesses, we will not get taxes and things like that. We don't want people to come and only participate in stock markets. We want people to do their businesses, earn, and then invest in the markets, right? So it's a different thing altogether. So I think dollar index is bearish. I would not say go long on dollar. I know it's a bearish signal, and because I'm not able to find great businesses like I was discussing with KB earlier, I'm also buying gold and silver because I'm probably anticipating hyperinflation or a superinflation phase, and I think those are the two hedges that one can take. There is no inflation rated instrument in India as of now. I don't think there is any instrument that gives you bare minimum inflation. Also in India, the problem is we do not track inflation very closely. US inflation is tracked very closely. In India, we don't track inflation very closely as an economy. That's another problem. But yes, dollar index is bearish. You can look at hyperinflation. You can look at inflation. You're already looking at inflation. It will impact businesses because the margins will squeeze up, and all those things are going to happen or might happen. But the best thing is assets will still perform. If there is a great asset, it will still perform. And dollar is not an asset. Dollar is a vehicle. Yen is not an asset. Yen is a vehicle. I think we've forgotten the difference between vehicles and assets, especially since the digital currency or the cryptocurrency season has come up. I will not take any questions on cryptocurrencies. I'm not an expert. I'm a 2-year-old kid.
The next question was about cryptocurrency only.
I know. So I think we've forgotten the difference between what are assets and what are vehicles. Gold and silver is a vehicle. Trust me, it's not an asset. It is only going to help me hedge inflation. It is not going to give me any alpha, right? And the reason I'm buying it because I'm not able to find businesses that are going to help me beat inflation, probably at this time. So I don't think only because I'm listening to few of my mentors and I'm doing my own research as well, but I'm not at a concrete decision. I don't think the dollar will tumble off of the roof or the dollar is going to fall. Again, the problem, the theory to it is a government can never default because it has a superpower, and that is called printing money, right? So they can print more money and they can feed all their bonds, right? What will happen is there'll be more circulation in the system. The assets prices will go up. You might not be able to afford to buy bread, but you will still end up with a lot of money that you hold against a pension policy or against a 10-year bond or against the NPS in India, 401k in US, and all these things. But do not go short on the world. Do not go short on the biggest economies. I don't think they're still, we're not at Armageddon situation as yet.
Okay. So the next question is from Ayush. He's saying, "Hi sir, what are the fundamental habits a person should have if someone wants to grow in finance domain?"
The first thing is look at money as a number. Don't have emotions to money. The moment you have emotions to money, things get very uncomfortable. You can either get greedy and try to cheat someone, or you can get fearful and not have the confidence required to be decisive. So the first thing is de-emotion yourself with money. You should have absolutely no emotions, even if you're talking about thousands of crores or 1,000 rupees. You should have a very rational mindset, irrespective of what quantum of money you're talking about. First, I think the second is when you're talking about this. The second thing is you will have to build a habit to live with difference of opinion and respect difference of opinion. People who are great, people who argue are not great investors. That is what I have seen. Because markets, nobody is right or wrong in the markets. Everybody makes money, right? People who are wrong will also make money. People who are right will also make money. It is subjective to how long are they making money. People who are right will make money forever. People who are wrong will make money a day and probably lose it the next day. So live with difference of opinion, respect difference of opinion, try to understand the other person, try to understand the person on the other side of the table. Because that is the person you're trading with. That is the person you're investing with or investing against at a given point of time. So I think the two fundamental things are don't have emotions when it comes to money, and don't have emotions when it comes to opinions as well. Be as rational as you want to be or as you can.
All right. So next question is, apart from capital adequacy ratio, what fundamentals should we give weight while selecting banking stocks? So just giving you a break for 30-40 seconds. Preksha, probably for if you want to analyze any banking stock in like say 2 minutes, we normally use a camel model, right? So first, C, capital adequacy ratio. A is asset quality. M is management quality. E is earning as in net interest margin of that bank, right? And then is liquidity, as in good banks getting liquid cash at very low cost. The reason probably SGFC is one of the best banks we have. They have probably 60% plus corporate banking share. So very easy, and probably if you can couple it up with credit growth of the bank in last like 3, 4, 5 quarters, it is a good enough signal to give you whether to go in or go stay outside. Emmanuel, if you can add to this.
Uh, I've been a great investor with ICICI, not that a big investor with HDFC. So I think in ICICI I hold somewhere around 7-8% of my invested capital. In HDFC I only hold 3%. So that's the gap. Now the reason is very simple. I am a customer both with ICICI, HDFC, Kotak. I have all these bank accounts. I've tried all them. I have taken loans from all of them. I've returned loans, all of them. I've lived the entire cycle of a customer who lives with them. And I found ICICI to be fairly more customer friendly and more satisfying with their online tools and all those things individually. That gives me more confidence to invest. So apart from all the quantitative measures that KB just mentioned, qualitatively, go to a bank, open an account, try to deal with them. How they serve you, how they treat you is exactly how they're treating everyone else on the street, right? And if they're not treating you well, if they're not friendly to you in terms of both investing side or the lending side, I think that's a bank you should not be investing in. I found HDFC to be slightly more insensitive And I found ICICI to be slightly more sensitive. That's my take. It can be very different. If you're a big HNI, probably HDFC का बैंक मैनेजर भी आपके पास आके आपके ऑफिस में बैठ के सब कुछ करके जाएगा. But I'm just talking like a normal guy. So I want to open a zero balance account or a minimum balance account. I will see which bank is entertaining me. If I want to take a small loan, I will see which bank is entertaining me. If a particular bank is entertaining me well, I will go with that bank. Also, one very key point: banks are the soul of a bank is its management. The soul of a bank is the team. Look at the top team of HDFC. Look at the top team of ICICI. Go through their profiles. Go through their resumes. You will have to have an eye of that HR kind of a thing. See which team do you like. So if you want to bet between India and Sri Lanka, probably the latest match, you see, look at the team, and then you can probably bet better, right? You can say India is a great team, and you or India always wins, and you bet on India and you lose the last time. But if you looked at the team, you would know Sri Lanka is a better position team in the last. KB is a cricketer. I'm not. I'm just taking an example out of it. So look at the teams, and if the teams are great, the business is going to be great. For example, if you compare Kotak to any of these banks, you will see Kotak slightly weaker team, slightly weaker, right? But that slight weakness is shown in numbers. All the numbers that KB just said, put all these three banks through those numbers, and you will find the first is right now is of course HDFC, but ICICI is overtaking at a very fast rate, and probably the least will be Kotak. So I'm just trying to tell you out of the behavioral side of it of how I invest. But again, all those ratios are of course there. Thank you, KB.
And then HDFC versus ICICI going on since almost 2000. ICICI was initially the king, then probably lost out the battle after Mr. Kamath went out. And now, since last probably 2, 3, 4 quarters, ICICI doing pretty well. So this is probably a race. 1 and 2 would probably fight very closely.
And I've really seen something very different. Just to say, the MD CEO just saying, I don't want any salary this year. Right? That's a great signal. That's a great. That's a great initiative. Probably it adds to the margins. Okay, I think KB is stuck, or am I stuck? KB, are you there?
We both are. Okay. It better. All right. So just adding. I do a lot of business in loan side as well. So probably I can say that probably 18 months back, ICICI started focusing on the profitability. They were not focusing like we want to lend to every damn person at probably a margin of 30, 40, 50 paisa, but we want to make profits now. And they started making, they increased their rates, but then ICICI is also doing good, and then they're managing their profit pretty well. Probably coming out of that direction only. So after that questions, there are a lot of thumbs up coming up. Great sessions are very informative. So that we know 7, 8 great. And you have been a karate. All right. There is something you have been a karateka. How is that help you in professional life? I am also a karateka. I want to know what is a karateka.
Oh my god. So I'm a second in black belt in martial arts, I think, and that's way long. It was when I was in school. It just helps you in being calm when hell is breaking loose around you. Nothing else, nothing apart from that. There is no flexing skills, or there is no power required when you are an investor. There is no fitness certificate required when you are an investor. It's just that if you're in the right mental health, and if you can isolate yourself from your emotions, if you can isolate yourself from how you feel in your personal life, you can be a great investor. And also, if things are not going great around you, but if you can stick to your disciplines, if you can stick to your rule book. I have a rule book. It's a small diary, and I carry it wherever I go. So, and if I'm about to do something significant, I just have a rule book. I have list of rules for everything I do, especially when it's about capital allocation. I read it every time. For any allocation that I have to make more than 3%, I go through the rule book again. And I am the one who has written it, but the objective is still the same. You tend to forget. You are a human being. You will forget things. It's just about recalibrating them and referring to your own rules every now
Then
and
we are over with our questions, Emmanuel. And probably if I say the key learning for me in this session would be probably be as systematic and as disciplined as you are. So that is what probably in coming days or coming months, I will try to be more disciplined. Thank you so much, Emmanuel, for giving us this session on probably 2 hours from your very, very busy life and probably missing football also. Thank you so much. My interns are actually liking it. I am getting so many comments in our WhatsApp group and probably a couple of them on YouTube live session also. Thank you so much. We would like to have you once again whenever you are free. Uh, you can add 2-3 lines to it and probably we can end the session.
No, nothing here. I think I've taken a lot of time. Thank you guys for whoever has tuned in. And if you want to reward me and KB for doing this, just make money. Don't lose money in the markets. Make money and try to look at markets as an instrument to change your life and not to make your life. It's very different. Two very different aspects. Don't look at trying to use markets as wealth generation platforms. Look at markets as wealth maximization platforms. That is one thing that I would want you to repay me and KB as. Just get rich through use markets to get rich. As simple as that. And thank you so much for sparing your Friday evenings. And KB wanted to keep it on a Saturday evening, so you got to thank me for that, for shifting it to Friday. So thank you so much for spending 2 hours with us. And if you have any, if you find anything that is ambiguous to you, if you have a difference of opinion, if there is something that you want to add, if there is something that you think you need more clarity on, most welcome to come back to KB or come back to me. We might be very late in our reply or slightly late in our reply, but we will make sure we revert back to you. That's it, KB. I think we should call it a day and let everyone grab their dinners.
That. Thank you so much, Emmanuel. It was